This looks like a strong performance, particularly in a world where commodity prices are still lower than they were in 2015. So what's behind these results?
Well, first, I think it is a strong performance. The key things that we did is we looked at all of our operations. We've improved our productivity on an annual basis by around 18%, building off a 41% improvement over 3 years. We've dropped our costs to almost 31% over the same 3 years. And so when you unpack all the moving parts, I think the most significant numbers to focus on. In 2015, we had an EBITDA margin of 21%. Prices in 2016, 3% lower, and we've seen inflation, yet our margin's gone from 21% to 26%. And I think that is really a demonstration of how far we've come in a relatively short period of time.
A year ago you set out an ambitious asset disposal programme, but now it looks as if you're backing away from it. Why is that?
Probably best if I said a little bit of context. Back in 2013, we talked about reducing the number of the assets in the portfolio. We had around 30 assets that we didn't think would make or could make a material contribution to the business over the long term. So we set about reducing the size of the portfolio and focus on quality. At the end of 2015, debt was almost up to 13 billion. We saw commodity prices dropping fairly dramatically. Diamond market was pretty tough given we'd filled the pipeline. And so we needed to take some big steps to make sure we got our debt down. And so what we announced was some additional disposals to deal with the debt. Now, along with cost reductions, capital reductions, and the delivery of around $2 billion in asset disposals, we've gone far beyond the debt target that we set the course of the year, and therefore we can pull back now on the asset program designed to work through the balance sheet. But we will continue to clean up the portfolio as we articulated back in 2014.
So now that the balance sheet is much stronger and net debt is below your target, are you planning to keep your coal, iron ore and nickel assets?
I think I need to be clear. We've reduced the debt 40% in 1 year, and based on our current performance, we'll continue to reduce our debt. So I think the imperative that drove the need to sell some of those quality assets has certainly been dealt with. For us, we will remain in those quality assets that we think can make a significant contribution going forward. So the answer is yes. We've got a great portfolio. We're going to continue to improve the business, and we certainly believe we can deliver the returns we've been talking to for the last 3 years.
Can we turn to South Africa? You've talked before about selling your Kumba iron ore and coal businesses. Is this still on the cards? And if so, what are you trying to achieve there?
Well, I think the first thing to do is make 3 key points. Firstly, we've done a lot of hard work in the last 3 years reconfiguring and improving the business. Every one of our businesses is making cash. We've delivered a 40% productivity improvement and our costs are down 30%. We'd acknowledge the South African government in the way that, whilst they've been tough, they've also been constructive as we've conducted those restructurings. So today, we're happy to be there, to be as we are, and to continue to improve our businesses. Now for us, any conversation around improving the portfolio, the delivery, or even the configuration is something we'd consider only as long as it delivers value for all of our shareholders. And for us, that's the key measure, delivering value for shareholders.
Looking at the bigger picture, are De Beers platinum and copper still the priority? Or is it the case that all the assets and all the businesses in the portfolio are now being treated equally?
Well, I think the first thing to start with and recognise in a portfolio of assets is not everything is the same. We think about the assets, each asset competes for capital, and across our whole portfolio we're trying to improve every asset. And I think that's important to recognise, and all our assets get what we believe is the appropriate capital allocation. But in diamonds, not every one of the assets is what we call tier 1. But it's the global offering of product that we provide to the market that adds value above and beyond the individual asset value we look at. So we take that broader context into account when making a decision in diamonds. Now, In our met coal business, where we have two great assets, we don't have that same global context, but we still want those two assets to be competitive, to play their part and deliver returns. So there is a slightly different dynamic, but every one of the assets is important. But we do think about them a little bit differently depending the portfolio that they're sitting within.
Given that commodity prices have risen so steeply, are we going to see you thinking about growth again by developing some of your other projects, such as the Quellaveco copper deposit in Peru, for example?
I think the first thing for 2017 is to continue the debt reduction work, and that remains a priority. Consistent with that, shareholders do come first, and paying a dividend is absolutely critical. Now, once we're through those two positions, where to from here becomes an important consideration, and Quellaveco is a good example. For us, it's important that the copper price is strong, that we believe we're investing the right amount in bringing that type of project forward. So that type of project will have to wait for the balance sheet to be right, and for us to be comfortable with the copper price and not simply be reacting to some short-term issues in the copper market. So it has a little while to wait yet, but certainly by the end of the year, I think we'll be in a different set of conversations where those types of things will be given our full consideration, but not until we've done the debt and we've delivered a dividend to shareholders.
You're reporting a 25% increase in EBITDA despite commodity prices being down on 2015. Can you explain the driving factors behind this performance?
We are very pleased with the financial performance. So despite a 3% decline in basket price, we have delivered a 25% increase in EBITDA. That was driven by a 2% production increase and a 9% reduction in unit cost.
You reduced your capital expenditure very significantly in 2016 to $2.5 billion. Is that level sustainable going forwards, or should we be looking for an increase?
Well, we reduced the level of capex from $6 billion in 2014, $4 billion in 2015, and $2.5 billion in 2016. That was on the back of the completion of three major projects: Minas Rio in Brazil, Gashoko in Canada, and Moranbah Grosvenor in Australia. We expect to maintain the same level of capex in 2017 despite the completion of these projects. We will see an increase in maintenance capex and development.
You suspended dividend payments at the end of 2015. So what needs to happen before you can start paying them again?
Well, we have made significant progress on the balance sheet in 2016. The level of net debt was reduced from $12.9 billion to $8.5 billion at the end of December. We expect to make further progress in 2017, and we will be in a strong position to reinstate the dividend for the end of 2017.
So what is the new dividend policy likely to look like?
We have indicated that when we reinstate the dividend, the board will put in place a payout ratio that will provide flexibility through the cycle. We will provide further detail at that time.
You talk about targeting a return to an investment-grade credit rating. How important is this for your debt refinancing program?
We already meet the parameters for investment grade, and our bonds are trading as such. Our priority remains on operational improvement while maintaining capex discipline. We would expect to move back to investment grade during the course of 2017.
In many ways, 2016 clearly a very good year, but you must be concerned about Anglo American's safety record. What are you doing to stop workplace injuries and fatalities?
Well, for me, 2016 was a great year in terms of the progress we made across a number of fronts, but with one significant exception. Safety, 11 fatalities. I mean, one fatality is one too many. 11, unacceptable. So for us, the focus on critical controls, making sure we plan every job, taking into account all the risks, is absolutely critical for us. And so a lot of work going on in getting those elements right. Now, at the same time, our all-injury frequency rate was almost down 30%, so that's encouraging. Our environmental incidents are down 85% since we started measuring progress in those areas. So some good progress there. What we have to do is make sure that we get safety right. And no other results matter unless we get that key statistic right.
This year, 2017, of course, a very significant one for Anglo American because it marks the company's centenary. What does this incredible milestone mean to you?
Well, I think the most important milestone is you have a company that has been able to survive 100 years. I mean, that's a magnificent milestone when you think about it today. I think the FTSE 100 average is around 18 years. And so 100 years, it talks to the people, the perseverance, the courage, the ability to innovate and continue to remake itself. And we're going through one of those periods today. So a great milestone, a great credit to the founders of the company, and today a great credit to every individual that works in the business as we set up for the second 100 years.